Imagine a nation at the height of its industrial might. Railroads stretching across continents, factories humming with promise, stock prices climbing steadily as if nothing could interrupt the ascent. But beneath it all, a quiet contradiction. Silver, pulled from the earth in unprecedented volumes, was flooding the system. It promised prosperity for miners and farmers alike. Yet it was eroding the foundation of the currency itself. You might think the warning signs would be obvious. Sharp drops, panic in the streets. But markets don't always crash with drama. Sometimes they form a rolling top, a slow, deceptive peak where everything looks healthiest just before the shift begins. And as an investor, you know this. The real consequences aren't always in the headlines. They're in the mechanics below, and the danger wasn't in the price. It was underneath it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. So what happens when an industrial boom in a key commodity starts to strain the very system it's meant to support? Let's step back to a moment when silver was not just a metal. It was the thread holding an economy together. Picture the American West in the late 1880s, vast mines in Colorado and Nevada, alive with the clatter of picks and the rumble of ore carts, silver pouring out like water from a spring, fueling jobs, towns, and dreams of expansion. This wasn't abstract finance. It was human ambition etched into the landscape. At the heart of it was the monetary system, a bimetallic standard where both gold and silver backed the dollar. The government had committed to buying silver each month, turning it into coins or notes. It seemed straightforward, a way to keep money flowing, to balance the interests of East Coast bankers and Western producers. At the time, this looked stable. What no one questioned was the structure holding it up. The system didn't emerge from nowhere. It was born from real pressures in the aftermath of the Civil War. Farmers in the Midwest and South were drowning in debt, their crops fetching lower prices each year due to deflation. They needed more money in circulation to ease the burden. Inflation, in other words, to make repayment feasible. Western miners faced a similar bind. New discoveries, like the Comstock lode, had unleashed a flood of silver, driving prices down and threatening livelihoods. Policymakers, including figures like Senator John Sherman of Ohio, saw a solution: mandate government purchases of silver. The Bland Allison Act of 1878 started it, requiring the Treasury to buy between $2 and $4 million worth monthly. They believed this would stabilize prices without overwhelming the gold reserves that underpinned international trust in the dollar. It was a compromise, rooted in the genuine hope that bimetallism could bridge regional divides. One key assumption: silver production would remain manageable, not explosive enough to force a choice between metals. It worked, but only under conditions that would not last. As the 1880s progressed, the system accelerated logically. Silver mining boomed, with production jumping from about 63 million ounces in 1880 to over 120 million by 1890. The Sherman Silver Purchase Act of 1890 amplified it, obligating the Treasury to buy 4.5 million ounces monthly, nearly the entire U.S. output at the time. This expansion gained legitimacy. It delivered real benefits: jobs in mining towns, relief for debtors through modest inflation, and a sense of national unity. Railroads expanded on the back of this growth, connecting markets and boosting trade. Stock prices on the New York Exchange rose steadily, reflecting the era's optimism. But for each success, an unintended consequence emerged. The influx of silver notes led to redemptions for gold, as investors preferred the scarcer metal amid growing doubts about the dollar's backing. Treasury gold reserves began a subtle drain, dipping below comfortable levels. Temporary stability masked this. Policies like higher tariffs under the McKinley Act of 1890 aimed to protect industries. But they deferred risk by insulating the economy from global pressures that would eventually break through. Prices were improving. The plumbing was changing, the underlying flows of reserves and trust in the system. The stronger it became, the harder it was to stop. Then came the crack. Not a thunderclap, but a series of quiet fractures. In February 1893, the Philadelphia and Reading Railroad, overextended from expansion, went into receivership. It was an early warning, tied to the broader overbuilding fueled by easy money. Gold reserves at the Treasury fell perilously low, hitting the $100 million mark that symbolized stability under the Resumption Act. Foreign investors, spooked by events like the Bering crisis in Argentina and banking troubles in Australia, began pulling gold out of the U.S. institutional blind spots played a role. Policymakers focused on surface growth, ignoring signals from commodity markets. Wheat prices crashed in early 1893 due to global oversupply, echoing the silver glut. Yet the system held, with no immediate collapse. Nothing collapsed. And that was the problem. The breaking point arrived with precision, though it felt inevitable in hindsight. On May 5th, 1893, the stock market plunged after the National Cordage Company, a firm attempting to corner the hemp market, declared bankruptcy. The Dow Jones average dropped sharply, triggering bank runs across the country. President Grover Cleveland, newly inaugurated, identified the Sherman Act as the culprit. He called a special session of Congress, and on October 30th, 1893, they repealed it. It was a reasonable decision at the time. Gold reserves had dwindled to $80 million, risking a forced abandonment of the gold standard and international panic. Cleveland's choice, supported by Eastern financiers, prioritized monetary orthodoxy. But it accelerated the deflation farmers had feared, contracting the money supply just as credit tightened. From this point on, the outcome was no longer optional. The consequences unfolded with quiet relentlessness. Over 500 banks failed by year's end, and 15,000 businesses shuttered. Unemployment soared to 19% nationally, higher in industrial states, 25% in Pennsylvania, 35% in New York. Families lost homes. Soup kitchens became lifelines. Who benefited? Eastern bankers and gold advocates who solidified control over monetary policy. The repeal shifted power toward urban centers and away from agrarian West, paving the way for William McKinley's 1896 election on a gold standard platform. Who absorbed the cost? Miners saw silver prices plummet from 1.29 per ounce in 1889 to 0.63 by 1894. Farmers faced foreclosures, fueling movements like populism. Structurally, railroads consolidated under figures like J.P. Morgan, who reorganized failed lines and borrowed gold for the Treasury in 1895. Power transitioned from decentralized bimetallism to a centralized gold standard, reshaping global trade alignments. Today, silver's story echoes in subtle ways, implicating us all in familiar patterns. No one can predict markets, but frameworks help us recognize the terrain. Consider the rolling top logic. Markets often peak gradually, with prices holding steady, while underlying conditions erode. It's not about timing the turn, it's about awareness of the shape. Prices are the headline. Plumbing is the story, the hidden pipes of supply chains, reserves, and incentives that keep systems running. Take the yield curve as an example. When short-term rates exceed long-term ones, an inversion, it signals potential stress. But the uninversion, when the curve normalizes, has historically aligned with shifts into downturns, as seen before recessions from the 1970s onward. It's a framework for posture, not panic, sizing positions with room for the unexpected. In silver's case, industrial demand has grown steadily, from photography in the 20th century to solar panels, electronics, and electric vehicles today. By the mid-2020s, over half of global silver use was industrial, up from a third 2 decades prior. This creates incentives. Producers chase output, users secure supplies, investors hedge. History doesn't repeat events, it repeats incentives, like the drive to expand amid apparent abundance, deferring risks until they compound. Late cycle psychology creeps in, complacency when metrics look strong, overlooking gradual strains like supply deficits or policy trade-offs. The key is risk awareness, positioning for resilience, not forecasting the pivot. It's about seeing the system clearly, from the mind to the market. Systems endure through adaptation, not invincibility. And that's the first takeaway. What looks like strength can mask fragility when plumbing falters. Human behavior, though, is the constant. Our tendency to extrapolate the present, ignoring quiet dangers until inevitability sets in. If this helped you see the system more clearly, subscribe to the Wealth Timeline, because the next story won't predict the future. It will help you recognize it